Okay, good morning. We're going to get started. You'll need to go into learningcatalytics.com. Couple things to note. If you're using an iPhone, the best browser is Chrome. If you use Safari on an iPhone for Learning Catalytics, chances are you'll answer a question and get booted out and have to log back in. So to avoid all that, if you use Chrome as your browser, you should not have any difficulties like that. Learning Catalytics, the question is up right now. You should log in to learningcatalytics.com with your MyAcademyLab login. Now, there is a question up. It's asking you for a number. It's related to last week. It would be good if you could answer it. You need to answer some way. And don't put dollar signs or commas in your answer. This question is going to stay open for a couple minutes. I'm going to start talking, but it's on your device. When you come to class, typically there'll be a question waiting for you to answer. You can go ahead and answer. When you answer a question, you would type your answer in, and then you will hit save answer, submit, and then watch for it right there. Watch for it to tell you that it was saved and submitted, and then the screen will go back to just the basic question. So do that. We're going to get to that in a minute. A couple announcements. Okay, so homework due this week is Chapter 2 homework. Chapter 2 homework in MyAcademyLab. There are 3 chapters in the book that are fundamental to everything we do this semester. And as you would expect, there's chapters 1, 2, and 3. Chapter 2 to me is one of the biggies, the huge one. It's going to impact the entire rest of the semester. The exams in this class are not cumulative, but the concepts definitely build on prior chapters, especially these. Learning Catalytics, session ID is up here. Okay, so here's the question that's in Learning Catalytics. And so while you're answering, if liabilities are 500 and assets are 1,200, what's equity? To log in, you would log in to learningcatalytics.com. Session IDs on the screen. Haley will continue to put it in the chat room. But I wanted to say something about Learning Catalytics. I sent an email out last week and said, I put your Learning Catalytics scores in MyAcademyLab. You should have gone to Learning Catalytics and clicked on into MyAcademyLab, clicked on results, and then you'll see all your scores for the class to date. And you'll see January 21st for last week. You should have a score. Now, some people emailed me and said, I don't have a score, but I was in class. Well, generally what happened when that happened was when the person registered for MyAcademyLab, they registered using a nickname. I also had one where the person's first name ends in R, but when they signed up for MyAcademyLab, they unintentionally left the R off the first name. So it wasn't matching up. So if we get a mismatch, I need to know about that right away. I can get it resolved for you generally within 48 hours, but I have to know about it. If there's a mismatch, this isn't something that's going to go away. You have to look. You cannot, typically, just a heads up, I just answered a question from an earlier class. You can't right now go on your phone usually and check your grades in MyAcademyLab because it'll, depending on what operating system you have on your phone, it won't work. Learning Catalytics will work on your phone just fine. MyAcademyLab depends. So go to a computer. So what you need to do today is make sure your score from last week was in there. If it made it into there, chances are you're good, but you're going to need to check today also. I'm going to email you out today, again, an announcement once the scores are there. You need to check. I am happy to help you with figure out, we can figure out why it's not working. I would say, and I can generally tell that it's working for most people because I can see there's hundreds of scores there. So generally it works. But if you're in a case where you had a nickname, you used a nickname, or it didn't match up for some reason, you might be showing a 0 or showing nothing there. If you see the date there in MyAcademyLab, I've uploaded the scores. You just don't have one, which is a problem. So it won't necessarily say zero, it'll say 0 or nothing, but you'll see today is the 26th, right? You'll see Jan 26th today. And once you see that, if you don't see a score, you need to send me an email and tell me you're not seeing the score, but you were here. And so that's scenario 1. You need to check. I will correct up to a week, but if you let a week go by and then you say to me, let's say worst case scenario, 6 weeks from now you say, I haven't been getting Learning Catalytics credit. Well, you're only going to get credit for the most recent class. I'm not going to go back 6 weeks and fix it. So you need to let me know. So if it's not, so after the first couple weeks you check it, it's working fine, then you can forget about it. It should be good. Another thing, Learning Catalytics works very, very well. It's very reliable, but you have to make sure when you submit your question, visually watch for that question to go in there. If it doesn't get your answer, you're not going to get credit for it. It will absolutely. If you've answered it and you've submitted the answer and you get that confirmation that your answer has been recorded, you're good. You need to watch for that when you submit it. Because if you're missing a question in the middle, it means that typically what we see then is maybe you lost your internet connection in it, or your Wi-Fi is in and out choppy. It's usually not in this classroom, it's you're somewhere else. So you need to watch and get that visual confirmation that it accepted your answer, and then you'll be good. But you do need to check your scores. So this question, Learning Catalytics, is in Learning Catalytics. You have probably another 10 to 15 seconds to answer it. Get an answer in. Again, we are doing participation only today, so we're not grading for accuracy. So you can, I don't want you to answer just any answer, but you could get credit for any answer. Make sure you get an answer in. I'm going to go over the answer right now. We are not closing the question for another 10, 20, 30 seconds or so. So you're not going to see it close on your device, but I'm going to go over the answer. So if liabilities are 500, assets are 1,200, equity is going to be 700. Okay, we're taking the accounting equation, solving for the unknown. So the $700 equity. Okay, so this question, we're going to close it. I'm going to leave it open for a minute or two for latecomers. Don't typically do that. We typically, let's see, we started class 7 or 8 minutes ago. You'll probably have to get answered earlier than that in the future. Okay, so we're going to be doing transaction analysis today. So what we're going to talk about today is we're getting ready. Our goal, like when we start talking on Wednesday, we're going to be talking about debiting and crediting things. If you had financial accounting in high school, you'll have a little bit, this will sound familiar. If you haven't, this is all very different sounding. It sounds like a foreign language, and we'll just have to work through that and get familiar with it. So we're going to start today by talking about different types of accounts. And we're talking about when we have a transaction, how do we record it? We'll actually do journal entries on Wednesday. We're not going to do anything with journal entries today. We're going to look solely at transactions today. So first thing is, what is a transaction? I'm going to give you some examples. Okay, and just as a reminder, the PowerPoint slides are on Blackboard. They do not include Learning Catalytic questions, and they don't include the homework problems because of copyright issues, but they have all these slides, and they have other slides that provide additional information too. So you may want to download those. But transactions, let me go to the next slide, and then we're going to come back to this one. For every transaction, there's two sides. Typically, there's giving and there's receiving. So you give something and you get something. And we record both sides. This is double entry accounting. Every transaction has two sides. So let's go back to these transactions. So let's say we're Whole Foods Market. Whenever we talk about transactions in this class, we're talking about it from the standpoint of the business. So this is Whole Foods Market. Here are some examples of transactions they could have. First of all, they can purchase fresh produce. So when they purchase fresh produce, they're going to have inventory. That's what they're getting. They're getting in produce, and they're paying cash. So that's a transaction. We can reliably measure it, and it has two sides. We have sell product. They can sell you something. So you buy something at Whole Foods. Whole Foods has a transaction. They're getting cash. They're giving up inventory. Whole Foods can borrow money. Whole Foods can go to the bank and borrow money. So what they get is they get cash. They give up their IOU. They have a debt now. They can repay a loan. They can give up cash, and in return, they're released from their debt. Okay, so these are all transactions, and this would be a financial transaction is a financial event that has impact, a financial impact on the business. Okay, so we have two sides, giving, receiving. Okay, and if you have, so again, financial impact on the business measured reliably. Okay, when we talk about accounting, so again, two sides. We can measure it reliably, has financial impact on the business, and we record both sides. This is called double entry accounting. Okay, so this whole chapter is about transactions. So a transaction is a financial event reliably measured. So we have a question coming up now. So we have a Learning Catalytics question coming out. And this question, okay, which of the following events would not be recorded in the accounting record? So we're asking for which event is not a transaction. So which of these events is not a transaction? The company paid a monthly utility bill. The company issued 100 shares of common stock. The company purchased 2 acres of land for future plant expansion. And the company signed a contract to provide services in the next accounting period. Again, this question is on Learning Catalytics. You do need to answer to receive credit for class. And today is participation-based, so there is no harm in getting it wrong. You do want to try to get it right because it helps reinforce it for when you see these questions perhaps on an exam. Please do not ask Haley about scores. Okay, if you have questions about your score in Learning Catalytics, right now we're having class and Haley can't answer those, plus it's a personal thing. If you have questions about your score in Learning Catalytics, I will tell you right now, if you got 8 out of 10, 80%, we had 5 questions last week, that means you did not answer one of the questions. This is what I'm saying. When you answer a question in Learning Catalytics, you answer the question and you watch the screen to make sure it says, thank you, something about your answer's been submitted. Okay? You need to see that screen. If you see that screen, you're golden. But if you don't get 100%, it's because something happened, maybe your Wi-Fi went out temporarily or something, but your answer was not received. Questions are graded for participation. So if you answer it, you're going to get credit for it. But again, Haley cannot answer grade questions in the chat room ever. Okay? She's got plenty to do without trying to look up grades too. Plus, it's not the venue you want to discuss your grade in. Okay, so with this one, we're going to close it in 5 seconds or so. Okay, and the answer is the event that is not a transaction is the company signed a contract. Signing a contract may be a significant event. It is not a transaction because it cannot be financial. It can't be measured. Okay, what did we do? We didn't do anything yet. Okay, but all the other events, we paid a monthly utility bill. We know how much it is. We wrote a check for it. There's actually an exchange there. The company issued 100 shares of common stock. There's an exchange there. The company purchased 2 acres of land for a future plant expansion. So those are all transactions. The last one, signing a future contract, that may be significant, but it is not a financial transaction. Okay, next up, what we're going to do is we're going to talk about a bunch of different kinds of accounts. And again, I want to refer to you to the PowerPoints. We have a lot of, I have several slides that give you more information of each of these type of accounts. What we're going to see here are simply the names of the accounts. What I'm going to do right now is I'm going to put these, we're going to go through some sample asset accounts, some sample liability accounts, some sample equity accounts. So I'm going to wait for a minute while you write these down, and then I'm going to talk about each one. Okay. I turned audio off for a moment. I was talking to someone. Okay, so these accounts, I'm going to start at the top. These are assets. These are sample assets. This is not a complete list. Every company has their own slight variation of account names, but these are common ones. The balance sheet we talked about last week. We start the balance sheet with assets, then we go to liabilities and equity, and those are the accounts we'll talk about today. So when we start the balance sheet, we sort the balance sheet in order of liquidity, meaning the closest to cash we have. So the first account listed on every balance sheet, and every company has it, is cash. And cash includes coin and currency, but it also includes deposits in the bank, U.S. Treasury bills, things that are equivalent to cash. So cash is the first thing, and that is an asset. Then we have accounts receivable. Accounts receivable are amounts that our customers owe us. So we're talking about from the standpoint of the business. Accounts receivable are amounts that our customers owe us. So this is, we've sold our customer inventory, and our customer says, I'll pay you in 30 days. So that is accounts receivable. An asset is a future economic benefit. It's something that's going to benefit us in the future. And certainly, cash is a benefit, has economic value. And accounts receivable has future economic value because that's going to turn into cash. They're going to pay us. They're promised to pay us. We're going to get cash down the road. Okay, notes receivable. Notes receivable is similar to accounts receivable in that someone owes us money. But notes receivable has a promissory note attached to it. So a note receivable, we've actually loaned someone money. So if I were a bank and I made a car loan and you come in and you sign the papers for a car loan, that's a note receivable for the bank. The bank is owed money, and that's an asset to them. Now, a business that's not a bank can have an accounts receivable or a notes receivable. Most sales that a company makes in ordinary course of business would be accounts receivable because you extend credit to your customer, they pay you within 30 days, you're good. But once in a while, especially businesses that sell big things, I know where I worked before, let's say the company sells forklifts. And forklifts are kind of expensive. So what the company that sells forklifts offers to do is they said to the customer, if you don't have money to buy it right now, that's fine. How about if you sign a note So you get the forklift now, you sign a note with us, and you'll pay us back over the next year, or you'll pay us back in a year or whatever it is, but we're going to charge interest. The big difference between accounts receivable and notes receivable is notes receivable has interest on it. Okay, you pay interest on a note, and it has a promissory note. So it has a legal document where you've signed saying you owe the money. So accounts receivable, kind of business to business, extending credit for ordinary purchasing. And then notes receivable, there's some promissory note agreement and interest is involved. Banks have lots of notes receivable, but other organizations can as well. Accounts receivable, always a short-term asset. Notes receivable can be short-term or long-term, okay? A lot of times we look at them as short-term, but they can be long-term. And the difference between short-term and long-term, one turns into cash within 12 months, the other one more than 12 months. The reason, for the most part, the reason we care whether something's short-term or long-term is because our investors are very much interested in whether we can pay our current obligations. So as an investor, if I'm analyzing a company, I want to look at it and I want to see if they can pay their obligations, that they're not going to go belly up in the short term. And how do I do that? I want to look and see how much they owe over the next year. And then I want to look at the resources they have available to them over the next year. So that's why when we prepare financial statements, we show, well, here's what we've got available to us in the year, and then here's what we owe in the year. And so that's why there's this short-term, long-term split, because when we prepare financials, we show that. Okay, so we're down to prepaid expenses. Prepaid expenses are expenses that we pay in advance, like the name says. There's several different kinds of prepaid expenses. One example could be prepaid rent. Oh, okay. Okay. One example could be prepaid rent. A business might pay its rent a year in advance. In return, the landlord might give a pretty hefty discount. So we pay our rent a year in advance. So when we pay our rent, that's an asset called a prepaid expense. This is one of the few accounts that doesn't match what like prepaid expense sounds like it should be an expense. It's an asset. So we have future economic benefit. We have the right to live there, stay there for 12 months. So each month that goes by, our asset decreases in value. We talk about that in Chapter 3. But prepaid expenses we pay in advance. An example, we have prepaid insurance. If you pay your insurance for Progressive a year in advance, they give you a pretty good discount, so businesses might do that as well. Those are prepaid expenses. When we buy them and we pay them in advance, they go on as an asset, and then in Chapter 3 we talk about how it reduces. Another prepaid expense that doesn't have the word expense in it is supplies. Supplies are things that we use, we consume in our business, but we don't necessarily consume them the minute we buy them. For example, I might go out and buy $500 worth of copy paper. Now that's going to be an office supplies expense over however long it takes me to use it, but it's not today because I have all these boxes of copy paper. So what I do when I buy it is I put it in a prepaid expense, and that prepaid expense is called supplies or office supplies. So that's an asset. And then when I use it up, it'll go over into supplies expense. The next account down seems like it's closely related. It's inventory. Inventory is specifically stuff that I buy to resell to my customers or to make into something for my customers. So I might buy wood to build tables. Wood is inventory. Tables that I built are inventory. So I buy something. If I'm if I'm the limited, I buy clothing and it's in stock. That's inventory because it's being held for sale to customers. Supplies are things that I use up in the course of my business. Inventory is what I sell to customers. So those are all short-term assets. Now on the other column, for the most part, notes receivable can say long-term notes receivable. Okay, next side. These are all long-term. We have land. We have buildings. We can have equipment. This equipment's like computer systems. It could be cars. We can have furniture and fixtures. If we have a retail location, it's all the racks and all the display cases. All of that's considered to be a long-term equipment. Land, building, equipment, furniture, and fixtures are all considered to be property, plant, and equipment, and they're things that we use in the business that have a long life, and those are considered long-term assets. And then we'll have a whole slew of other assets that we do during the semester. So these are examples of assets. What you're going to be expected to do is you're going to be expected to look at an account name and identify, is it an asset, is it a liability, is it an equity? We'll have a few practice ones today, but those are sample assets. They are not by any means all the assets we can have, but those are good representative accounts. Okay, next up, liabilities. Liabilities are debt. It's something that we owe. Okay, we owe our liabilities. Okay, accounts payable is the top one. Accounts payable is the most common liability. Accounts payable is when we owe vendors. Typically, accounts payable comes up in the course of business. And I'm going to be quiet for a minute while you write these down. Audio is going to go quiet for a minute as well if you're online. Okay, so let's start at the top of the list. Accounts payable. This is the mirror image of accounts receivable. Accounts payable is what we owe for stuff that we bought. So we go buy inventory and we owe our vendor. This is what we buy in the ordinary course of business. So if it's a vendor we use for whatever, that's accounts payable. Typically we owe it within 30 days, so it's definitely a short term. Salaries payable, just an example of a whole slew of payables. We could have taxes payable. These are all things that we owe but that we're not paying right now. You know how your company typically pays you, you have to work for 3 weeks before you get a paycheck because there's a lag there? That would be in salaries payable, what they owe. Accrued liabilities, we'll talk about that in Chapter 3. Not now, but if you see accrued anything, it's a liability. That accrued is a tip-off that this is a liability. Short-term notes payable. Short-term note payable, we've gone to the bank and got a loan, or we've somehow signed a note. It carries interest with it. It has a promissory note. So you see the word note, there's a promissory note, and there's interest involved. Now, current portion of long-term debt. This is actually an account and always seems the weirdest one to me. But let's say you go take out a 10-year loan and you have to make payments every month. So that's a 10-year loan, a 10-year note is a long-term liability. However, you're going to make payments this year. And when investors are looking at the payments we need to make this year, what we need to pay the first year. So that year, whatever's due in the next year, goes into current portion of long-term debt. So most of the long-term debt goes out in long-term, but the part that's coming up in a year goes in current portion. Mortgage payable is typically a long-term asset. Long-term note payable, long-term asset. Now, unearned revenue. I put this in here at the end. It's typically a short-term asset, and I want to emphasize it because it's probably It's probably the biggest misnomer that we see. We're going to see more of it next chapter, but this unearned revenue. Unearned revenue is a liability, and let's talk about an example of it. So Harvard Business Review. It's a monthly journal, and I just subscribed to it last week. So it was $99. So I had to pay Harvard Business Review $99. So I paid them $99. And now, from the standpoint of Harvard Business Review, they've gotten my money, but they haven't earned it yet. Because if they never send me an issue of Harvard Business Review, they owe me $99 because they have not delivered, they have not provided their product to me yet. So what they have to do when they get my $99, it actually goes into an unearned revenue account, which is a liability. They have an obligation to provide that product or service to me over the next 12 months. They do not earn it until they deliver it. So if this is a 12-month subscription, they would be able to recognize 1/12 every month until it's earned. But when you pay for something in advance, so when a customer pays us in advance for our product, it's unearned revenue. So it's actually called unearned revenue or deferred revenue, as the case may be. But it's unearned revenue, and it's not revenue until we earn it. And we'll talk more in later chapters about that. But I wanted to say this account called unearned revenue is a liability. Same thing. If you buy a concert ticket for a concert that's 2 months from now, the concert promoter, that is a liability for them. That is not revenue. They may say they sold, 100,000 tickets, but until the concerts are performed, then they don't have revenue. That sits as a liability for them. Okay. And that's typically a short-term liability, but I added it when I was thinking about it. It's different than the rest. It feels different. Unearned revenue feels like it shouldn't be a liability, but it is. Okay, and then we have equity accounts, and this we're going to expand to a much bigger list later. But for right now, we have common stock and we have retained earnings as our two equity accounts. Now, common stock is a very specific term. Every company that's a corporation has common stock. Some companies have a kind of stock called preferred stock, so we'll see that later. But every company that has stock has common stock. Retained earnings is a running total of all the net income to date, less any revenue, less dividends. Okay, so down below there, I have revenues, expenses, and dividends. Revenues and expenses and dividends ultimately, at the end of the period, impact retained earnings. And how those impact retained earnings is revenues increase retained earnings, that's why I have a plus after it. Expenses decrease retained earnings, and dividends decrease retained earnings. So that's why I have a plus and minus. We're going to do an activity today where we see that. But retained earnings is a running total of all the income to date minus all the net losses to date minus dividends. So it's this accumulated total. We're going to later, like Wednesday, we're going to have revenue accounts, we'll have expense accounts, but they are fundamentally part of equity when it gets down to the basic accounting equation. Okay, so what we're going to do now is we're going to do a series of questions. And these questions, you have to identify what kind of account things are. Just as a reminder, these are in Learning Catalytics. You have to answer the questions to get credit for them. And when you answer the question, once you submit it, you need to make sure, visually watch, and make sure your answer has been accepted. If your answer is accepted, you get credit for it. That's how you get credit. We are doing only participation for the first few weeks. I will let you know if and when it changes to any other model. But for now, if we have 10 questions in the class and you answer all 10, you get full credit. Okay, so first question we have, and again, the question numbers don't mean anything to you. Which of the following is a liability account? Retained earnings, accrued liabilities, accounts receivable, or prepaid expenses? We don't have chapter quizzes. I know. Okay, we're going to close this in about 10 seconds or so. Which of the following is a liability account? You can only pick one. Yes, your response has been hidden for privacy. That's what you see when you, yeah, okay. Yep. Okay, and you don't answer in the chat room, you answer in Learning Catalytics. Okay, so we're going to close this. And the answer is B, accrued liabilities. Okay, another one coming now. Goods purchased on account for future use in the business, such as store supplies, are called what? Okay, is everyone in here okay with Learning Catalytics? Anybody need any help with anything? I think we're good. Thank you, Justina. Okay, 10 more seconds on this one. I'm going to come look over your shoulder for a minute. Oh, good. Okay, in this one, the answer is prepaid expenses. Goods purchased on account for future use in the business, such as store supplies. Now, store supplies would be things, if I'm thinking of store supplies, I'm thinking of price tags, pens, pins, just things that we would use up in the business. Supplies, store supplies are not inventory. These are, if we're buying clothing to resell to customers, that is considered inventory. But when we talk about goods purchased on account for future use in the business, that would be prepaid expenses, none of the other things. Okay, another one. All the following accounts would be considered assets except for which one? Cash, retained earnings, prepaid expenses, or notes receivable? Okay, another 10 seconds or so on this one. All the following accounts would be considered assets except for okay, retained earnings. Retained earnings is an equity account. Cash, prepaid expenses, and notes receivable are all assets. And then we have one more question before we go to the next learning objective. Okay, any event that has a financial impact on the business and can be measured reliably is what? Okay, another 10 seconds or so. We have Jeopardy music playing in our heads, Haley and I. Okay. Okay, and that would be a transaction. Okay, next up, we're moving on to the next learning objective in the chapter, and we're looking at the impact of business transactions on the accounting equation. Okay, now, we are not doing debits and credits yet. We are not doing journal entries with this. We're simply looking at, we get a transaction and we have to identify what's being impacted by this transaction. So what we have, we're going to do this by example. So what we have is we have Dr. Luke opened a medical practice during the first month of operation, February. They experienced several events. So this is a corporation. We are doing everything from the standpoint of the corporation. Now remember, Dr. Luke, as the individual, is separate from the corporation itself. So what we're going to do, you have to do a little bit of preparation here. I put on the screen a series of columns. You're going to have to write, we're going to have several lines. We're going to use this, we're going to do a worksheet when it's all done. So what we're going to do is you need a column for the month. And then what we're going to do is we're going to have 4 columns for assets. Okay, so we're going to have a column for cash, a column for accounts receivable, a column for medical supplies, and a column for land. Okay, so we're going to be doing a whole bunch of rows, but these are our column headings. And then we're going to do 2 columns for liabilities. Okay, we're going to do accounts payable and notes payable. And then we're going to do 2 columns for stockholders' equity. We're going to have common stock and retained earnings. Okay, so we're going to be recording each of these transactions in this worksheet. So 4 columns for assets, 2 for liabilities, 2 for stockholders' equity. So we have 4 columns for assets beside their liabilities and stockholders' equity. So we end up with needing like 9 columns across. Now the point of this problem was to show the impact on the accounting equation. And the accounting equation is assets equal liabilities plus equity. That will be true after every single transaction. Our assets will always equal our liabilities plus our equity. We're using double entry accounting, which means there's always 2 sides to every transaction. So what we're doing in this activity is identifying what's being impacted and what kind of impact it has on assets, liabilities, and equity. So the first transaction, so these columns are going to stay. The first transaction, first transaction is Dr. Luke invested $100,000 in the business in return for common stock. So at the top of the screen, it tells us the transaction or tells us the event that happened. So Dr. Luke invested $100,000 in the business in return for common stock. So we're doing this from the standpoint of the business. So the business is getting $100,000 cash. So we're going to put $100,000 in the cash column, and we're going to put $100,000 in the common stock column because the business issued stock. So now the business has 100,000 of common stock. Common stock, that column called common stock, is equity. It's stock that the business has issued. If a business buys stock in another company, it's an asset and it's called investment. So if you see an account common stock, it is an equity account. It's stock the business has issued. So our accounting equation after this transaction is assets of 100,000 equal liabilities of 0 plus equity of 100,000. So we are in balance. Right now, as of the close of business on February 1st, we have $100,000 in cash and we have 100,000 in common stock. Okay? So that's the first transaction. That's why we say when we look at a transaction, we will see two sides to it. And in this case, we issued stock. Issuing stock is a really common transaction we're going to see in a lot of activities. So we're going to always see when we issue stock, we're going to get cash and we're going to give equity, common stock. So next transaction given to us. The business, February 5th, the business borrowed $50,000 signing a note payable. Okay. So if the business borrowed $50,000, it's getting $50,000 cash. So we're going to show cash, another $50,000 in the cash column, okay? And it's increasing, so it would be a positive. And the other side of this is the business now, they said IOU, they signed a note. So now the business has a note, and the note can be a payable or receivable. A payable is something we owe, so this is a note payable. So what you're going to see here is you're going to see cash going up by $50,000, and you're going to see notes payable, the liability, going up by $50,000. Now, if we wanted to right now, we could add each column across, and actually we can. It's really easy to do. Cash, we have a total of $150,000, right? Because that's all the activity that has gone on in cash. So assets are $150,000. Liabilities are $50,000 for that note payable, and equity is $100,000 for common stock. So liabilities plus common stock are $150,000. So my assets equal my liabilities plus equity. That will hold true all the time. If it doesn't, we've made a mistake. I'll answer that one because that could be. Okay. There's a question. What's the difference between accounts payable and notes payable? Very good, Brody. Yes. Notes payable has a promissory note, a legal document. Notes payable, you pay interest on it. Accounts payable is typically a shorter one. Okay. Okay, the transaction that we're recording for all of these, like if you're wondering why we just randomly put the 50,000 there, the transaction is listed at the top of the screen here. The business borrowed $50,000 signing a note payable. So every transaction, the top of the screen is going to change. So that's where we got the 50,000. Okay. Okay, so next up, February 8th, the business paid cash for land costing $105,000. Okay, so the business pays cash. So right off the bat, I like to look at cash first. What's happened to cash here? Well, the business paid $105,000. So that means we've got a cash activity, and the cash is decreasing. So a cash decrease, I'm going to put parentheses around it. I'm going to put it in the cash column saying it's decreased cash. And what did we get in return? We gave out cash. What did we get? We got land. So we're going to have an entry to the land column. So what we'll see is we've got cash being decreased for the amount that we've spent, and then we have land going up. Yes. Stay tuned. What? Whenever, the question is about seeing a parenthesis in a column. Whenever you see parentheses in accounting, that means it's a negative or a deduction. Yeah, that's a rule. It applies to not just this, but whenever you see parentheses, that means it's going the other way. Okay, yes. Everyone's reading your mind today. Okay? So just raise your hand and you'll know someone will ask for you, right? Okay. So if we were to stop right now, I don't have enough real estate on the screen to do it, but I could add up and get a balance of cash. My balance of cash would be $100,000 plus $50,000 minus $105,000. I would have, right now, this business has $45,000 of cash, right? And then I could go over and it has $105,000 of land. So the business has $150,000 of assets, and then liabilities, $50,000, $100,000 of equity, that's $150,000, so I am still in balance. My assets will always equal my liabilities plus equity. Okay, next up, the business purchased medical supplies for $1,700 on account. Okay, purchased medical supplies. Medical supplies, that's a prepaid expense. That's an asset, so it's going to go over an asset called medical supplies. So we have $1,700. We're getting supplies. Now the other part of this is interesting. The words on account. When you see those words on account, that will trigger, it should trigger something in your mind that says on account. That means either accounts payable or accounts receivable. 99% of the time. It's going to be accounts receivable or accounts payable. How do I tell the difference? Accounts receivable deals with my customers. Accounts payable deals with things that I've bought. So we look at this and we say the business is purchasing medical supplies for $1,700. The business is purchasing. The business purchases from vendors. So this is accounts payable. Okay, we're going to see accounts receivable coming up in a minute, but accounts receivable would deal with what patients owe, not, and this is a purchase the business is making. So what we're going to see here is medical supplies increasing by $1,700 and accounts payable increasing by $1,700 for the amount that they purchase on account. When you purchase on account, that's either accounts payable or accounts receivable. Accounts receivable is customers, and this is not. Next transaction. Dr. Luke Professional Corporation officially opened for business. Now that's an event. That is not a transaction. The reason it's not a transaction is because there's no financial value there. I mean, there's nothing that we can reliably measure. It's a significant event, no doubt, but it is not recorded as a financial transaction. Yes. Okay, I have a question. I'm going to go back to the last one. I have a question about this last one. Okay, this one. The business purchased medical supplies on account. It did not use any cash. The reason cash is not involved there is because they got medical supplies and they bought them on account. On account says, I owe you and I'll pay you later. Later on, when the business pays, there'll be a cash side of that, but right now they're not paying. So on account, so basically when you buy things, it's either going to be cash or accounts payable, one of the two. So good question. Okay, next up. Dr. Luke treated patients and earned service revenue of $5,600, receiving cash for half the revenue earned. So this one we actually have three numbers to deal with. Okay, so let's deal with the easy one. The easy one is earned service revenue of $5,600. Okay, so out in that retained earnings column, I'm going to put $5,600. It increases retained earnings. It's actually going to go to an account called service revenue. Now, so that part's done. We earned revenue. Now, how did that revenue come in? Did it come in cash or accounts receivable? Because revenue comes in one of two ways, either cash or accounts receivable. It says that we got cash for half of it. So half of $5,600 is $2,800. So we're going to have an increase to cash of $2,800. And then the other $2,800, the patients are saying, we'll pay you. You know, if you go somewhere, sometimes they'll say, we'll bill you That's going to go in accounts receivable. So this transaction is going to look like $2,800 going into cash for the portion that they paid in cash, $2,800 for the accounts receivable for the portion that they'll pay us later, and then the entire $5,600 goes out in the retained earnings column. This transaction didn't directly impact retained earnings. It actually goes into service revenue. Service revenue is an equity account. So we're going to put it all in the retained earnings column. This is ultimately what it'll affect, but if we were recording the transaction, it would go into service revenue. Okay, I'm going to do this one again. Okay. Okay, so just to recap what we've done on this one. So Dr. Luke treated patients. Revenue is recognized when you deliver the goods or services. So if we did the exams and we did the prescriptions and whatever else was needed, Dr. Luke, or the professional corporation, earned the revenue. So we have service revenue we're recognizing. Service revenue is an equity account. It ultimately impacts retained earnings, but we're not going to go there yet. So it's going to go out in the retained earnings column. It is an equity account. Revenues increase equity. Expenses and dividends decrease equity. Okay? So the service revenue is out there. Now, it said in the problem that they got cash for half of it, so $2,800 is increasing cash, and the other half the patients will pay later, so that's accounts receivable. So after this transaction, we see we have a debit. We have an increase to cash of $2,800. We have an increase to accounts receivable of $2,800. So total assets are increasing by $2,800, and then over there in equity is increasing by $5,600. So 2,800 times 2 over the one side, 5,600. 5,600 on the equity side, the accounting equation is still in balance. Every transaction, you can have a transaction where you have one asset increase and a liability increase. You can have a transaction we're going to see coming up here where you have an asset increase and another asset decrease. But the assets will always equal liabilities plus equity, both in the transaction itself and the overall impact. Okay, next transaction. The business paid employee salaries of $2,300. Okay, so the business is paying. When you see the word paying, that implies cash. Even though you don't see the word cash, it doesn't say on account, and when you pay salary, you pay it. Okay, so we paid salaries of $2,300. So what's happening here is we're paying cash. So cash is going to decrease. So we're going to see $2,300 deduction in the cash column. And what is that? That's an expense. And expenses reduce equity. So we're going to have $2,300 reducing assets, reducing cash. And then we have $2,300 out there in equity, reducing equity as well. We could be subtotaling after each one of these, but we don't have enough room to keep doing that. But every one has an equal impact on assets on one side, liabilities and equity on the other. Couple more transactions. February 25th, Dr. Luke traded patients and received $1,500 cash at the time of service. Okay, so here Dr. Luke, the corporation, has provided services of $1,500. So equity is going to increase by $1,500, and it tells us received cash at time of service. So we got $1,500 cash. So we're going to see cash we're going to see $1,500 increasing cash and $1,500 increasing service revenue. Okay, we have a couple more transactions on this one. So next up, The business paid office rent of $1,000. Okay, so we've paid office rent. Paying means that cash is being exchanged. So cash is decreasing. We pay out cash, cash goes down. So we have a $1,000 deduction in the cash column. And then office rent, rent is an expense, and office rent goes out in the equity columns, retained earnings. It will decrease retained earnings. So what we'll see here is a deduction to cash of $1,000, and then a deduction over in the equity accounts of $1,000, and that's rent expense. And we're just over and off in the side, I'm writing the accounts that we would actually use, but they all ultimately impact retained earnings. And I believe we have one final transaction. The last transaction, the business paid $500 on account. Okay, so right off the bat, we paid $500. There's cash involved in that. So I'm going to reduce cash by $500. So I'll have a negative $500 in the first column. And then what are we doing? On accounts. Those words on account mean that it has to be accounts receivable or accounts payable. And how you decide is you say, are patients involved, are customers involved? In this case, no. The business is paying $500 on account. That means it's paying off some of what it owes for accounts payable, actually. So it's paying on account. It's paying down what it owes. So what we're going to see here is we're going to see $500 reduction in cash and also $500 reduction in the liability because the business is paying down what it owes. It's not paying off entirely what it owes, but it's making a payment on what it owes. Yes. You would just date it. If you had a transaction on the same date, you would just have a second row with the same date. Yeah. Now, we've come to the end of our transaction, so what we're going to do is we're going to add up every column. And we're going to add up every column, and we will add the positive numbers and subtract the things that have parentheses around them. And I'm going to do it really fast here. Look at that. And so cash is $45,500. I've got to make a correction here. Okay, so cash, if I add up all the numbers in the cash column, I get $45,500. If I add up, well, I've only got one number in accounts receivable, it's $2,800. Land, $1,700 is my total. Accounts payable, I have the $1,700 that I bought initially. I paid $500 off, so I now owe $1,200 is my total. Notes payable, the balance is $50,000. Common stock, $100,000. And then out there in the retained earnings column, I have a total of $3,800. Now, going one step further, if I add all my assets together, so I'm going to add those first four columns. I'm going to add the cash, $45,500, the $2,800, the $1,700, and the $105,000. I get $155,000. That's my total assets. And then I add the next four columns, the liabilities plus the equity, I get $155,000. And I can say I'm in balance because the assets equal the liabilities plus the equity. Every time I do any transaction, the assets will always equal the liabilities plus the equity. If they don't, there is an error. Now what we're going to do, same example, we're not leaving it. Now we're going to answer a bunch of questions because what do we have here? We have a series of information that we can use to answer questions. So the first one, so the questions I have a series of questions, but I'm going to take those questions, don't have to write them down yet, at the top. So at the very top of the screen, you'll see the question. So the first question is, how much are total assets? Okay, So using this, we can answer the question, how much are total assets? We're going to see total assets are 155,000, right? Because that's the total of the 4 columns. Next question, how much does the business expect to collect from patients? Well, what's the balance of accounts receivable is what it's asking. Well, how much we expect to collect from patients is going to be the 2,800, the total of that column. Okay, next question we have, how much does the business owe in total? Okay, so when we're asking about how much the business owes in total, that's asking what's our total liabilities. Whenever you say owe or debt, that refers to liabilities. So I would add the 2 liability columns, the 1,200 plus the 50,000. Okay, the next question always throws everyone the first time through. The next question, how much of the business's assets does Luke really own? Okay, so how much of the business's assets, and to translate this, how much of the business assets do the shareholders really own? Well, when you talk about that, then you're looking at what's the equity. So the answer is going to be the equity. The total equity is always what the shareholders own. Remember that Luke is a shareholder. Luke is the owner, but this is a corporation, so the shareholder owns the equity in the organization. Just like you calculate your own net worth, that's how much you really own. That's what this question is asking. What's the equity? Okay, the next question is asking for how much net income or net loss. Now, net income and net loss are calculated as revenues minus expenses. We did that last week. Revenues minus expenses are net income. So when I look at this, I don't have any column that says revenues minus expenses. But when I recorded these transactions, the 5,600 was revenue out in that last column. Revenue was 5,600. Then I had expenses of 2,300, another 1,500 of revenue, and expenses of 1,000. So the answer for this particular question is 3,800. Now I want to make a disclaimer here. Net income is not equal to retained earnings. The only reason it's equal to retained earnings here is because we started with 0. Retained earnings is a running total of all our net income to date. Our net income minus net losses minus dividends. It's this running total. So if we had a beginning balance, retained earnings would be some different number. Income is always revenue minus expenses. Okay, so income in your first month of operation, retained earnings will equal net income in that one situation. But other than that, income is always revenues minus expenses. Okay. So that brings us to the end of this example. What we get into next is we do a homework problem. But I don't want to start that right now. So what I did want to say is in the next few hours, I have a couple people coming to see me during office hours. But when I get a few minutes, I'm going to transfer your Learning Catalytics scores from today into My Accounting Lab. You need to log into My Accounting Lab, click on Results, and then look at the activity. You should have a score for January 26th. If it says January 26th and there's no score, and you were here listening to me live and you answered questions in Learning Catalytics, you need to email me and we can troubleshoot it. You don't want to let it go long. But don't email me until I've announced that it's there, okay, because it does take me, I can't tell you exactly when it's going to go up. It's not automatic. But I'll get it there today. And I'll do an announcement when that happens. You need to make sure it's working. We can fix anything, but I need to know. So I will see you on Wednesday then.